Good morning, everyone. All right, so welcome. I am going to see how long this takes us today. I don't think it's going to take a lot of time to cover, but since we last did our affiliate webinar, there's obviously been significant change, as we all know, to self-managed super. And I want to rehash this. I want to make sure that we're very, very clear on the window that we have, and also beyond that, and what obviously is the functionality beyond it. So from property investors' perspective, we've always looked at self-managed super as an opportunity for our clients to then refer them obviously onto financial planning and whatnot, to get the advice so that they can actually buy something inside their super, for four main reasons. One is the capital gains tax, so they can actually sell that property in retirement, and in the meantime that property is obviously paid down, so they've either paid it off or almost paid the property off by the time they retire, because the principal interest loan the numbers don't really work for an interest only loan inside self-managed super, and there's whatever spread with the value and obviously being paid down, and then there's an asset that if they wish to, they can sell, not have the capital gains issue, and then extinguish debt on the other properties, right, that they've been using their income tax benefits on with their negative gearing. So that's why you'll find that most of our clients have at least one property in their super fund, or they're at the moment they're about to. So that's one reason. The second reason is leverage, obviously. So and I know that you guys would already know this, but let me just rehash it very, very quickly. So if I've got $300,000 in super and I want to buy a $600,000 investment property, and my super is getting a 5% return per year, the properties are getting a 5% return per year, return in terms of capital growth, then I could tip in, say, 200 into the property for deposit and costs, bank funds the rest. I've got 100 left over. Now I've got a $600,000 asset plus 100,000 invested in cash investments. And now I've got 700,000 getting a 5% return instead of the 300 I started with. So that's the second reason, or maybe it's probably the first reason. So we've got that, the capital gains, also what I can claim in terms of deductions inside the super fund. So in my experience, most clients, by the time they've paid for ASIC fees on the two companies, they've paid for a tax return, they've paid for an independent audit and some advice, it's sort of anywhere between $3,000 and $4,000 a year. So if they're contributing, say, 20,000 into their super, and they're already paying 15%, so you'll find that most of that is coming back as a tax credit when they're actually submitting their tax returns. So it's pretty much cancelling out whatever the fees would have been to actually run the self-managed super fund. And that's assuming that there was no fees in their pooled super fund anyway, which obviously we know there are. So, and the fourth thing is that there's diversity, right, actually in their super, because I remember when I had clients that didn't have any property in their super, they had the super heavily invested in cash investments and shares in 2008, and then obviously the stock market had a very significant correction that then halved their super, and eventually it came back. But the reason why my clients in their late 50s and 60s were pretty peeved is because they end up having to work longer than they had planned to, waiting for obviously that cycle to correct. So obviously you're limited to that exposure. So that's what we've always spoken about. Now, when the last election happened, the parties that I've been introducing clients to set up self-managed super started speaking about them becoming really, really busy, because there was a lot of talk, if you remember, in that election about Labor government accessing our pooled super to actually build infrastructure, and they're actually talking about building properties with that money. And it spooked a lot of people, and a lot of people were like, well, bugger that, I'm going to pull my money out and put it into SMSF. And if you look at who are governing those, those industry super funds, I mean, Wayne Swan at one point, maybe he still is chairman of Australian Super. I mean, there's a lot of the ex-government and also union-linked people that are actually involved in those industry super funds. They don't get the best returns. They're very high in fees. Their insurance cover is garbage for the premium that's paid. So obviously there's huge amount of money that's taken in terms of margins by those pooled super funds. And I've always called them like a casino. The house always wins, right, so to speak. And it's based on the premise, and this has been my experience. I don't know what your experience is, but my experience is when I ask a client for their super statement, and I look at the super statement, I'll say, do you know what your return is? No, right, for the previous 12 months. Do you know what your fees were? No. But they know that it's grown by X dollars. And it's like, well, yeah, that was your contributions plus whatever little return minus the fees that the actual fund is taking. So when I then say, well, who's Fred and Mary Smith? They say, well, that's mum and dad. And so, well, you've got mum and dad as your beneficiaries to your life insurance in case something happens to you. Don't you want your wife and children, or at least your wife, to be that? So it tells me, and this isn't just isolated incidences, this is 30-40% of the people I speak to, they literally are not reading their super statement. And my view is that that's what the whole industry is based on, is the assumption that people just aren't reading it. They're not seeing if they're getting a very good deal in their industry super fund, so they're not seeking advice. Now, a lot of people do seek advice. That doesn't mean they set up an SMSF, but a lot of people do seek advice, and they obviously get better cover and they get better returns and better investment because there's someone there giving advice and they're being accountable, right? So that's why I know what I know, because after doing this thousands of times with thousands of clients, when you ask for the super statement and you literally get blank looks about returns and about fees, I know straight away that they're not reading their statement. They're just literally looking at the balance and throwing it in the drawer. So that's why when the Labor government last election was talking about accessing those pooled super funds, a lot of money was actually draining out. Now, as we all know, Tuesday a week ago, the government announced that they did a deal with the Greens, and the Greens wanted to push for the fact that you can't borrow money inside your self-managed super anymore, so therefore you can't be buying residential property like people have been doing for a very long time. My view is, and this is just an opinion, is that was just a smoke screen. That was like the public front. The actual pooled super funds balances have been going down, and they've been all funneling out to SMSFs, and they were trying to stop that. So that's my personal opinion. Whether it's right or not, I don't know. It doesn't matter. But the point is, we now have a closing window, right? So the date for the last contract that can be written inside a super fund is the 10th of August. And so as a result, I don't know about you guys, but I've been pretty busy, right? Especially the last 10 days. It feels like everyone that I've spoken to about a strategy whereby they might think about putting a property in a super fund, feels like all those people have called me. And there's obviously a sense of urgency now. Now, there's a couple of issues. One is to set up a self-managed super fund, to get a statement of advice and go through that whole process with a planner, then to actually have the fund set up, so have the trust set up with the corporate trustee, and then get the rollover into the bank account with an ABN. That could be 8 to 12 weeks, right? Depending on sort of how cooperative everyone is, right? That are obviously with all those moving parts. But there is a way, obviously, to set up the fund, get the rollover happening straight away, and then obviously be providing a statement of advice post. There's definitely a way to do it. I don't know how that happens. It's not my game. I'm not licensed to do that. But certainly clients that I'm referring, to planners, that, there's an ability to obviously go about that process and stagger it. So that's what we've been doing. That's what's been happening. So as long as a contract of sale is written, and that gives us plenty of time still right now, because we've got about a month to actually be going through the process of drilling down with a property strategy, to then drill down to a point where we're presenting property options that would fit a super fund, right? So that's really what myself and my whole team, that's what we've all been flat out doing, and no doubt that's what we will be doing very, very flat out in the next few weeks. So that's a foregone conclusion. That's what's happening. What happens beyond that is already there's been a number of different parties that have actually now nutted out I don't like to call it a loophole. Let's call it a different structure whereby you can still be buying property and the self-managed super fund has the beneficiary of that property. So I don't want to talk about it now. It's not something that has been pressure tested. It's been presented to a number of different parties who have said, yes, that's compliant. The thing that I don't know is that will that, obviously pass the pressure test with lenders? It seems like everyone seems to think that it will, but I don't. Until it happens and until it physically happens, I don't know. But everyone is very, very confident. Like they're in the 90s percentile of confidence. That's where a lot of people are. So there's obviously a very, very big focus right now. I mean, we were going to talk about end of financial year stuff today, but it is July, and that was really something that we were going to run before the end of June, but just given with everything that happened and how quickly it all happened and how busy that we got, that's why we're now having this conversation today. But basically, I managed before the end of June, I had a webinar with all of our client base. And basically the main inference, just so that you guys know, was if you've had a good year, so let's say you're self-employed, or maybe you are employed and you've had a good year financially and you've got some surplus, talk to your accountant about prepaying expenses and prepaying interest, which is very realistic, and sometimes you even get better deals. But then you can be pushing over tax and deferring into obviously future tax years. So we had a chat about that in the last webinar. Obviously, no point having a chat with you guys about that today on the 7th of July. But what's much more relevant and what I know that would have been much more of a talking point for you today is obviously what's going on with super. So we are very, very proactive. There's a lot going on. I just don't believe that the future is going to mean that that we're not going to be able to actually still utilize super as an opportunity for clients, because it's demand. I mean, there's still plenty of people demanding it, which is why the whole Bear Trust model came out in the first place. I don't know if you guys were around or if you remember, but when they first set up, when they first announced the structure and the compliance around self-managed super funds in the early noughties, you couldn't borrow, right, to buy property. If you wanted to buy a property, no problem, you had to put down cash. And it wasn't until later that one very prominent law firm actually proposed a structure with the Bear Trust, and then that passed all the pressure tests, and then lenders started popping up all over the place. I don't see there being an issue with this new proposed structure post 10th. Obviously, there's no point even looking at it before 10th of August. Because up until that point, we can do everything compliantly, and that's obviously what we're doing. That's why everyone's very, very, very much in attention, right, and very attentive about the whole process. But beyond that, I just don't see there being an issue with lenders. I mean, there are lenders out there that you guys know about that their whole business model has been built on self-managed super lending. So, there's definitely going to be a pivot. There's no question. There's a pivot in this space. So this is probably the only really major pivot that that I've certainly in my career have had to do with clients, based on the guidance that we've given them in terms of how they structure. But we haven't had to pre-pivot on everything that's been done in the past. It's from this date forward. So we don't have to pivot in terms of the properties that we source, because that fits all of this new ruling on negative gearing anyway. We don't have to pivot in terms of the whole transition to retirement strategy that we had. But now it seems that from the 10th of August that we will be pivoting, and we have a pivot in place that we can actually implement once we've actually made sure that we've pressure tested that. So obviously, I would encourage all of you that whomever your contact person is at Property Investors, that you reach out, you maintain that communication between them. And I would suggest that if your experience with your clients is anything like mine has been with mine and my team's clients, is that there's a lot of conversations happening, right? A lot of questions are being asked. What do we do? How do we do it? And there's just obviously many ways in which you can skin a cat. So everyone is working very efficiently at the moment. Funny that, because obviously there's timelines. I mean, I had a conversation last night with clients that I wouldn't have had that conversation with them about super until their first purchase they made outside super the dust had settled, right? In other words, it's finished, they've got a tenant, and it's just the way that I've always operated. I've never applied pressure to clients unless there was an opportunity that came up, or in this instance, there's a closing window of opportunity. So it's been a very simple conversation that I've had with my clients. I wouldn't be doing my job. So I'm not saying, Mr. and Mrs. Jones, that you must do this, but I wouldn't be doing my job unless I actually informed you about what's going on. So would you like me to set up a meeting with a planner so that you can actually begin that process? And obviously I'm getting a resounding yes. So I would have thought that those similar conversations that you can have with your own clients, it's obvious. I don't know if you're a broker, I mean, I would be doing, whether it's a health test on their, a health check on their lending or whatever it is. I mean, you know your business and your industry much better than I do. But what I'm saying is that there would definitely be an opportunity for you to say, look, I really think it's a good time for you to speak to Tony or Jason or Mel or whomever is your contact person, and have a chat about what your options are and what those steps would be, and see how that would suit you moving forward, because there is a window of opportunity and it's closing, and it's obviously an opportunity for all of us to obviously work with that opportunity before it closes, right? There's no point telling everyone now about there's potential options beyond that, because it's not 100% yet. And at the moment, we've still got an opportunity to use, the existing system. So that was the main message I just wanted to communicate with you guys today, that we are very, very busy. There are very receptive clients and prospects out there talking about super because they know that there's a deadline. There's obviously the fair share of people that are full of fear too. It's like, that's no problem, right? I shouldn't be talking to you. And you know what? It reminds me of when COVID hit. So the beginning of March, April, May 2020, when I was speaking to prospects, I literally discovered, and this is what I then said to all future prospects, look, I've discovered there's two groups of people. There's people that are full of fear and they're running for the hills, and they want to put their head in the sand. No problem. You're not the people I want to talk to. But everyone else has said, Jason, there must be opportunities that has come from this, because I know that every time there is big change, there's big opportunities, and 100% there are big opportunities, which at the time happened to be Southeast Queensland, right? And so as a result, all of those people benefited massively because they knew that with change comes opportunity. So therefore, all the conversations I had with prospects were only people that were really hungry for the opportunity. And as Warren Buffett said, be fearful when others are greedy, but in this instance, be greedy when others are fearful, right? And that's exactly what's going on right now. And I'm having very similar conversations. There's two groups of people. There's people that are just full of fear. They're worrying about the property market without them actually really understanding what defined property market, because there's the median house price nationally, then there's state by state, then there's cities, then there's pockets within those cities, and then there's asset types within those pockets. I mean, there are hundreds of markets. So when people say the property market's like, my question is, which market are you referring to? Because if we had a stock market crash tomorrow, then I would say to everyone, watch what happens to the Gold Coast holiday apartments. What do they always do? They always correct. That's why I've never invested in them, ever. Never guided a client to invest in a holiday apartment in my life, because they're lifestyle related. So when wealthy people who have a lot of their money in the stock market, not necessarily because they're share traders, but they're in business and they do acquisitions, and maybe they're on a share deal as well as obviously their big salary. So a lot of wealth have a lot of their assets actually in the stock market. So if the stock market halves in value, then they quite often will sell down, right? So they'll actually scale down their principal place of residence. So you'll see luxury properties correct, and then you see holiday properties. So, the Sorrentos and Portsies of the world, and also the Gold Coast apartments of the world, all of those all correct, right, during those times. Now, we've never had as part of our strategy clients investing in those types of properties, because the rule number one is you invest in properties where someone always needs to live no matter what happens to the economy. World War III, I still need to live somewhere, all right? So I still need to live somewhere no matter what. And so if people are downsizing during a stock market crash, if they're going from a $2 million property to $1 million property and so on, they're putting a downwards pressure on the median house price, while the 80% of the rest of the population is putting an upwards pressure on the median house price. And so that's why we're very, very close predominantly to median house price, whether that be with apartments or a house or a townhouse, it doesn't matter. But all of the other, the other pillars apply, right? Must have a minimum yield of 4%, must be heavily gentrifying, and there must be obviously a population growth in the area subject to supply. So the supply is catching up to the demand, hence therefore the properties are new. So, again, I was taught all of this 30 years ago by someone who's much smarter than me. He's now a billionaire. And I've just repeated what he's taught me. I've repeated in my own, for myself and for clients and for everyone that I've spoken to in big groups of people. And it's just always held true. And he was the one that taught me, well, what's the worst that the government can do in terms of making taxation change? And if they start messing around so much that median house price drops 15%, well, that's a monumental disaster. And it wouldn't matter if you got one investment property or 10, you wouldn't be worrying about that. You'd be worrying about, okay, what am I going to do about the problem with the banks? Right? Because the banks are leveraged to, well, they're leveraging up to 61% LVR, right, across the board in all residential property in Australia. Now that's massive. We've never been at those sorts of levels before. And now we're at these fractal reserve lending ratios that are way beyond the Great Depression. So, and I just want to remind you one other thing. PEET, very big property developer, land banker. So that would be what, third biggest, second biggest. They're the oldest developer in Australia. They're the third oldest company in Australia. So they've been around since 1800. So think about that. They went through the Great Depression, 2 world wars. They've been through all, Black Monday. They've been through, the GFC, the whole lot. And so what did they do post, the budget? They started increasing their prices on the, the next stage release. The business as usual. They didn't change it. Because they understand how the cycle works. It's only people that are literally frozen in fear, watching the mainstream media every night, right, and literally shitting themselves. They're people I don't want to be having conversations with because I can't deal with that level of programming, right? It's people that actually can see past that and see outside and go, what's the opportunity of how to make money from this current circumstance? And there are an enormous amount of ways to do that. All right, so let's leave it at that. That's about 20 minutes. I don't like going too much longer than that because we're all busy. So obviously, for those of you that are here live today, thank you. For those that are not, I'm talking to as a recording. Thanks, everyone. We'll see you in a couple of weeks. All right, you have a very good day. Cheers.